Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
So some comments on vol. Is it high or low? Well, the current vol might be high relative to historical standards, but it might be low, or it is low based on the last 18 months. It's not right or wrong, but it does represent a current consensus. It's considered by many to be forward-looking, and it represents a lot more than just price distribution. When you're trading options, you always need to think about risk-reward. So if I'm looking at the CDD, does it make sense for me to be a buyer of the CDD calls or puts, or am I better off being a buyer of a spread where I'm mitigating a lot of that risk? Or hedging also. So as I showed you many of the charts, if you look at equities, normally you're going to see an inverse relationship, at least normally. It's not always the case. Be careful, correlations can change. So hopefully you'll understand that, and then you'll make the appropriate decisions. Why does the volatility vary? Because investors' risk appetite changes. People right now, and I'm generalizing, but people are willing to take more risk. How do I know that? Volatility is lower. When volatility is higher, people are trying to avoid risk. And that's just a generalization that makes sense. Many major market events have come off what was, in hindsight, a volatility extreme. The way to measure how much exposure you might have to volatility is what's called what are called the option Greeks, but specifically Vega. Vega theoretically quantifies how much an option should or might change based on changing implied volatility. So here's the chart, U.S. dollar against the euro. So interestingly enough, if you're buying an option, you need to think about this, because if you're buying an option, let's say in November, you didn't know it at the time, but at least you could have looked at like a frame of reference, is that you might be thinking something's going to happen, but look at the option premiums. The relative option premiums were extremely high. So if you bought an option, you might have wanted to have a pretty tight stop loss order so you didn't necessarily lose your entire investment. Because volatility, some would say it actually moves in trends. So you had the upward trend, you had the downward trend, and now we're sort of in a neutral trend, and that trend will change also. But again, what I find to be very interesting here is that we've been, in the media, everybody's been talking about Greece, Portugal, Italy, Spain, and all that. But the options market basically says that it doesn't necessarily matter. For the last 5 months, everybody has been talking about Greece defaulting, and maybe something very bad is going to come out in the next week or two or next month, but the option market doesn't think so. And if you're interested in what's going on in Europe, please go back to the archives and listen to John Netto's presentation just from 2 days ago. I think you'll really enjoy that. So here's the dollar against the pound volatility, and you're seeing the same sort of thing. So are options cheaper now relative to where they were 14 or 15 months ago? They are much cheaper. Does that mean they can't, or they won't go any cheaper? No, of course they can go cheaper. The amber line is what's expected in the future, so we're looking at about a 11% move based on today's trades. And the blue tells me how much the underlying dollar pound actually moves. So the dollar pound, as of about 2 months ago, was only moving at a 9% rate, hardly moving at all, especially when you're paying about a 13% to be long those options. So here's a real interesting one, and that's why you have to be careful with these trends, because you might have said, okay, well, here's the uptrend, there's the downtrend, and then here's the neutral trend, so you're good, right? There's a neutral trend. Well, what happened? The neutral trend collapsed, and it went into another negative trend, which we're in right now. Volatility going down almost each and every day, and volatility down and around the 9% level. The Canadian vol a couple of years ago was trading at 7. That doesn't mean it couldn't go to 4 or 5, but Anything's possible, and that's what I've learned over my almost 30 years of trading options, is that anything is possible. So a friend of mine said to me a month or so ago, don't you think that CDD vol is cheap? And he sent me this chart, and now I like to sort of remind myself that just because it's trading in a new low and it ticked up a bit doesn't necessarily mean that it's going to continue, right? Because you look at that chart, 11%, and what happened now? That was a little tick up and then down to 9%. So if you had bought options, you had probably gotten hurt. So let's look at some option premiums. Remember, when you're trading options, you're trading volatility, because these option premiums are based on volatility. So of course, they're based on the intrinsic value, but they're based on the volatility also. So the in-the-money options are least sensitive to volatility. The at-the-money options are most sensitive to volatility. So if you're looking at the 103 calls, that's all volatility there. Whether you're trading a 10-day, a 44-day, or a 73-day, and you see the premiums there. The greater the premiums, the greater the length of the option, the greater the premiums. And I just mentioned that the at-the-monies have the largest nominal. Out of the money have the largest percentage. I did not mention that. And the in-the-money have the small. So if you just wanted to trade options and not worry about volatility, you could trade in-the-money options. The problem is, in-the-money options have the greatest dollar risk. So if I'm trading in-the-money options and I'm looking at these CDD calls around 103, again, this is priced a couple months ago. The 97s and the 97 calls were in the money, and the delta was 99 for the 10-day or 91 for the 44-day. So as you move out through time, the delta actually dwindles in the in-the-money options, but it increases for the out-of-the-money options. The at-the-money options, it's about the same. If you look at the 103, 106, and 109s, though, as you move out, your deltas pick up. But those are out-of-the-money options. Very important. Now, you got Vega, and then as we go through the out-of-the-money options, if the volatility was to decline, well, the Vega is going to hurt you. If the volatility is going to pick up, then Vega would help you. So how much would I be hurt or helped by that? Well, it's going to be based on that Vega number. So I have a 10-day Vega of, let's say, the 103 of about 0.064, 0.143, or 0.18. So much greater risk towards volatility with the longer-dated options. But again, the one benefit of the longer-dated options is I have more time and I don't have to worry so much about time decay. So today I'm just really talking about Vega. Delta and Vega for puts. So if you're looking at the deltas, the in-the-money options are going to have deltas that are high, and the Vegas that are actually pretty low. As I move down in delta, I start to increase my Vega, and my Vega is going to be greatest at the money. So the greatest risk for volatility is buying an at-the-money option. Delta and Vega risk. So here we are with the options, 97 all the way through 109s, the 44-day options or the 73-day options. So this is a couple things I always look at is what are the option prices, and I want to know what the Vega is. And again, you go to FX options, and we have a calculator there, so that can help you. Your brokers are going to have calculators also. Spreads can help mitigate this volatility risk. So if I did the 97-103, the spread could be worth 6. I might pay 471. My net Vega actually is that I'm picking up about 13 cents. Means that if the volatility was to move down, I might make 13 cents. If I did the 100-106, my Vega is almost 0. So one of the primary reasons that you might implement spreads is because there is a much lower exposure to volatility or Vega risk.
Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.